For more about the jobs and the economy, we're joined by Thomas Hayes, founder, chairman, and managing member of the Great Hill Capital. Good to see you again. You know, if this was a week ago, I would be clapping my hands, celebrating what an amazing bull you are. But this past week, I feel like the mood has changed a little bit on Wall Street in the sense that we're getting these numbers and everyone's trying to look for this negative angle on each of these data sets. And today was a good example, right? We had the jobs numbers, the markets rallied, and all of a sudden, somewhere in the middle of the day after lunch, trader says, we don't like it. What happened?
Well, I think the most important thing that happened with this jobs report is it gave the Fed more cover to skip a rate hike in September. And you saw it in the Fed funds futures, assigning a 12.5% probability of raising in September. So that's good news. Then you looked at the inflation numbers in recent weeks with PPI nearing deflation at 0.1% and CPI at 3%. We're going to see some new data next Thursday, as Karina alluded to. That's going to be important. But I think the key thing here is, you know, last month before the revision, you had the lowest job growth in 19 months. I mean, with these numbers, you're probably over 2 years, the slowest jobs growth. So the Fed can kind of skip and allow more data to come in. Even the JOLTS report was down this week. So I think the good news is it's this perfect situation where the economy is going well enough, but the inflation and the labor is soft enough that the Fed could actually skip and be more and more data dependent.
So why didn't Wall Street like the, I mean, what's with today's reaction that we ended up so negative? And this week, quite frankly.
Today had nothing to do with the jobs report. It was all about Apple. Apple's down 4%. It's a huge weight in the S&P 500. The market didn't like the outlook for Apple. Services were good. Handsets were a little bit weak. And you've got Apple trading at 33 times earnings with 7% earnings growth. Of course, it has to take a break. You couple that with seasonal weakness. August and September, as you know, are among the worst months of the year. However, institutions missed the first half of the year rally. That's evidenced by their positioning and their cash. So I think any of these seasonally weak pullbacks, 3%, 5% pullbacks, are going to be aggressively bought. And those folks that missed the rally that are looking for a 10% correction are going to be waiting for a long time.
Some are talking about this this flattening of the yield curve, right? You have short-term rates that are high, or higher, and then you have long-term rates that have recently kind of perked up above this 4% level, and some people are making a big deal about it. Explain to us why we should watch this, if at all.
Okay, well, the guy who invented this indicator was out on public media within the last 6 weeks saying that this time is different. So the guy who invented the indicator said, don't pay attention to it. But the most alike period that we can look to for the inflation hiking and the steep aggressive actions by the Fed is 1980 to 1982. And you had an inversion and then you had a reinversion, just like we had in 2020 an inversion, 2022 a reinversion. But by that time in 1982, the market was already rallying and it never looked back. And if you look at earnings, earnings are now coming in much better than expected. It's a redo of Q1, where estimates were expected to be negative 7%. They came in at negative 2%. As of today, Q2 earnings were supposed to come in at negative 7.3%. They're now at negative 5.2 with 21% left to report. So we'll finish, call it negative 4, negative 3. The key is analysts were too pessimistic and they have to take up estimates. And you're seeing it for 2024. They took them up to $246 for the S&P 500. That's good news for the economy.
Thomas, I absolutely love your optimism, which is why we love having you on the show. So let me get this straight. You think that, not you, but the market thinks that they're unlikely to raise rates come September. The jobs numbers is generally positive because it shows the economy is healthy. Earnings, as you say, are coming in better than expected. So I'm just going to lay it out there. You're bullish and you're telling us we should buy stocks going into the end of the year. And if so, where?
Specific stocks. I wouldn't chase the indices. You had 18% ups the first half. That's not going to be replicated. We're looking for mid-single digits for the indices, which are weighted with the Apples of the world, which have to take a breather. The Magnificent Seven that led the first 5 months are going to take a breather. We like other stocks that haven't moved yet. We like Mickey Mouse. We like Disney. The parks are reopening in China. Everything's getting back in action. They've got the best content library in the world. They've got the best parks in the world. And by the way, the stock has only fallen 50% 3 times in the last 30 years. 2000 to 2002, it fell 60%. The great financial crisis, it fell 57%. And in the last 2 years, it's fallen 58%. You get a chance to buy one of the best properties in the world at 50% off. This doesn't happen very often. We think over the next 12 to 24 months, the stock can be up 50 to 100%. Iger's going to right the ship. They've got the content library. They'll add some bundling. They'll add some ads to the bundling. The parks will be humming, and China will reopen, and they're off to the races. So we like Disney.
You're making my kids real happy. I think each of them have like 1 or 2 shares, so we'll have to buy 1 or more. Real quick before you go, I know you've liked China stocks in the past. They've had a fairly big hiccup. It's been, for some people, a disappointment, but for others, if you got in the right time, you made money. Do you still like Chinese stocks, and if so, which ones?
I love them more than ever. Alibaba, the cloud, is just getting started with generative AI. The compute power demand is unlimited. They're going to spin that out. They're breaking it into some of the parts. The Chinese government is going to do aggressive stimulus in the back half of the year. They've said as much, and we're going to start to see it. They want to bring down youth unemployment. They want to grow the economy. They're going to do all of those things, and Alibaba is going to be the toll taker, the major beneficiary of that growth initiative. Remember, they've only been open for 6 months. It's getting started. You're seeing Wyndham was out this week saying how good things are happening in the last 6 weeks in China. Starbucks was out. Nike, we're going to see the numbers. MGM China. So all the companies reporting are saying, wait a second, the last 6 weeks, things are starting to hum in China. And you couple that with some stimulus, you couple that with being the greatest property in China in Alibaba, we're off to the races. So yeah, Alibaba's up 20 points in the last few months. That's just the beginning in our view. Over the next 12 to 24 months, this is going to be a lot higher.
Thomas Hayes, Great Hill Capital, a bull. You like China. You're buying. Good to see you. Have a good weekend, my friend.
Thanks, Phil.